lower. After running a short-term high, it breaks lower. We have an imbalance near the upper end of the hourly imbalance, which is that pink shaded area. So we can take that off. That's been incorporated here. And we know that the market's drawing higher into a optimal trade entry here. And also, the lowest band or level of that optimal trade entry, your 62% retracement level, what agrees with that lower end? So we have the optimal trade entry, a run above a short-term high. This candle's high here comes in at 98,888. The high on this candle comes in at 98,887. Okay, so it's 1 pipette below. You're going to be doing 5 pips below because you got to factor in the spread. If you're looking for this level to get in, ideally, that's the lowest easy objective for a premium array, you would be 5 pips below that price level. So it would be 83.8. So let's do that. I know, I could just as easily just type that out, right? 83.8. So that would be your entry on a limit. Okay. Now using this, once you have the range you're looking for optimal trade entry, your entry for limit purposes, because you want to sell a little bit early because the spread has to be incorporated. We're using 5 pips spread, and we're allowing for this much movement here. Now, if you're entering with the premium array when bearish, after it's ran up into all the factors that I went through from top down, you're going to use a 25 pip stop loss. It'll be a 50 pip stop loss if you use the alternative entry, which I'll show you again in a second. So 25 pips plus 83. So 10 would be 93, 103, so 108.9. All right, so that would be your risk on the trade there. Okay, so we can take this off. We have framed the idea here. And that is the risk during the London Open Kill Zone entry. And what we're going to do now, and again, this would all be done before the price even trades up here, while it's all doing this, okay? Now you're going to take the Asian range and do standard deviations to the downside. You're going to get both measurements. You're going to get the wick to tail, and you're also going to do 100 pips. So this is your entry at that level there. So 83.8. And that should be 100 pips. Okay, and that's the range that we're looking for best case scenario on this model. Okay, so 100 pips from entry. This is the rejection block. Remember that dashed line from the weekly? And notice how it reaches into that old rejection block with 100 pips right there. That by itself, my friends and neighbors, is very, very tight in terms of clustering. If we look at the price level here, 86 even, and it's 83.8 down here. That's the low. Is that less than 5 pips? Yes, it is, friends and neighbors. So now we're going to go into this measurement on the bodies of the candle, the highest up close or opening to the lowest opening or close. Okay, I just want to double check the close on that candle. 679 open here. 679 open. 679 close. 679. Okay, so that's the actual range. Now we can go back out and see if there's any standard deviation that lines up closest to that 100% projection in terms of the model, and a standard deviation that is within 5 pips. All right, so we have $1.0891. That one is just, in my mind, it's not that good because it's over 5 pips. We have the rejection block, which by nature is what we look for to trade through that. So what are we doing? We're expecting it to trade down below the rejection block. So what would be the next standard deviation below the rejection block? With volatility being what it should be in the direction of our weekly expansion, we're looking for it to trade lower. We're not trying to limit the weekly range to 100 pips, but we're anticipating a target that all these things that I've taught you align with. The next objective would be 1.0881.5. So that level there. We'll use that as our objective, and we'll change that to a dashed line. Okay, and I'll thicken it up because I want it to be much more pronounced versus this rejection block. Now, let's go back out to a 15-minute time frame. So we have price trading into that level here on the 6th. So Tuesday's trading, Wednesday's trading, it trades into it there. And then the rest of the week, we consolidate it and then once more down in there. So we have 100 pips from entry here, clustered with a standard deviation, -9. So this particular day, right there, you're getting your 100 pips on that move. Now, you're going to aim for this, obviously, but your target fills sooner because the model says once you get 100 pips, you're out. You're done. Does it move much more than 100 pips from your entry up here? No. So you're going to lose sleep over that? I wouldn't. Now, if we look at that in terms of the day of the week, here's Tuesday, Wednesday, and you'd have to be out of the market on Thursday at New York Open. It went a little bit lower there that day, and they had this reversal. And that was before New York Open. See that? So let's go back over here. And let's assume for a moment that you either missed this entry up here or you want to use this model I'm showing you here, which is the European Open. So there's midnight. So now we're going to use 2 o'clock in the morning. So there's 2 o'clock in the morning, the opening price. Yeah, I'll just use this one because we're already done with it. Opening price there. So 2 o'clock in the morning, opening price. You want to be a seller above that opening price. But you have to be a short seller on a stop one pip below the Asian range. Like that sound effects? All right, so we have what is that here? Get that out of here. So midnight to 8 o'clock. Asian range low. Right there. Okay. At 2 o'clock in the morning, right there, your order cannot go in to sell on a stop until after 2 o'clock in the morning. So after 2 o'clock in the morning, you're looking for the market to create a short-term rally, which we're getting here. So once it starts to rally and it trades above the Asian range high over here, once that occurs, we're having what? Market contraction or Judas swing. So you may be fearful. How far can it go? I don't want to get into it and it stops me out. Okay? Like if you don't trust this part of it, which is in my mind the better way of doing it. But I understand some of you want confirmation. So after 2 o'clock in the morning, you're waiting for a rally to take out the Asian range high. Once it does that, after 2 o'clock, this is the time window element. So time is important here. You're looking at 2 o'clock, you're going to wait. Does it start to rally above the Asian range high? I don't have the Asian range high in here, but you obviously know it's above the Asian range low. So it starts to rally. So right away, we can then put a sell stop 1 pip below the Asian range low. Now, if you're going to use this as your entry technique, there's nothing wrong with it because you're selling weakness once the move has already established the intraday high. So we're going to say that's, let's make sure first, it should be 64.5. That would be your entry on a stop right there. So below the Asian range low. So you're not trying to guess how far it's going to go up. You don't care. But should your stop be filled, you have to use a 50 pip stop loss. So you'd get in on there. And then you would $10, $20, $30, $40, $50. This should be 5 right there. So here's your 50 pip stop loss. So you're selling short. Scrunch this up so you can get a visual of what's actually occurring here. Hopefully I haven't lost you. It's rallying at 2 o'clock in the morning. You're waiting for it to rally. Once it takes out the Asian range high, and let me just put that in now because it'll make better sense now that I have it dressed up like this. Once you do this on your own charts, it'll be much more meaningful to you because you'll be able to put the price action axis and time. You'll put the charts the way it looks nicer to you, instead of how I have it. I know what I'm looking for, but this might not be so aesthetically pleasing to you at the moment, but I promise in a second it will be nice. And then the Asian range high here after 2 o'clock, right here, you're waiting for it to rally above the Asian range high. Once it does that, you're putting a stop on, to sell stop as the entry. So you're not really buying anything and putting a sell stop below to protect anything. You're placing a sell stop at that price level. Once this Asian range high is taken out, once it trades above it, it's it. So you have to wait post 2 o'clock in the morning here. Asian range high is taken out. You can put a sell stop down here. And that way you don't have to guess how far it's going to go up. And it'll only put you in once it starts to go down. Once it breaks the Asian range low, which it does here, you have a 50 pip stop loss. You're filled right on that candle right here. Or you should be. Let's see what the low is on that. 62.3. Yeah, you should. I mean, depending on what your broker is. You know, if they're fickle, they may not fill you there. But you get filled here for sure. And once that fill is done, even if you got filled here, you're not even getting half of the stop exposure with this retracement higher. It spends some time in here, but you're sleeping. You know, once you put your order in, you put your stop in, and your limit order in, down here at 100 pips, you're done. You just let it do what it's going to do. It's either going to stop you out, or it's going to hit your objective down here. Now, you can put 2 orders in. You can put one short on a stop, selling at 109.65.4 with a stop loss up to 110.14.4. So that would be your 50 pip stop loss, excuse me. And then that one contract or lot, standard lot, whatever you're trading, mini, micro, whatever, would come off at 100 pips. And then the second order, so you would place 2 orders, because that's what this model is calling for. Your second order, you're getting out at 50 pips. So you're going to take 50 pips off on one of the standard lot, micro lot, mini lot, whatever it is you're using. And then you're holding the second one until it gets down to hopefully 100 pips. So both of them would have been filled. And you can see this was the result. So it fills you here. You never even make it to Thursday. But had it not filled it on this drop down, it would have happened here. If it wouldn't have happened at all, say it consolidated longer, you would have been filled here on Thursday, early morning before New York opened, and you never would have suffered any of that drawdown back into, and maybe, you know, even stopping you out. Now, once you move 25, the way you do your stop loss is real easy to remember this, by the way. My stop loss protocol managing the trailing stop loss is 25, 50, 75. Okay? It's 25% of what you expect to see in profit. If it starts to see that, like right here, your stop loss can drop 25%. If it drops down in your favor and you're making 50% of your expected profit objective, your stop loss drops 50%. And then once it drops to 75% of what you're expected to make in your profit, your stop has to be at break even. It never, ever, ever comes close to break even. But that's the protocol for stop loss management. Okay. So I've literally taken you through model number 2. I broke down how you could have applied it to this actual event. We called Euro lower. I gave you a very specific element of entering on the 5th based on the 4th's commentary. This movement up in here, that was that hourly imbalance. Let's go back up to the hourly. And this one will be done. All right, and Go back and listen to the commentary on the 4th, and you'll see me refer to how on the 15-minute time frame, I believe it's what I was looking at, I said that we were likely to go up into that, and it's based on the hourly. So one of the things that I know some of you want me to do is be highly detailed about everything and why I'm outlining it. The reason why I'm not doing so much of that when I'm giving the commentary, number one, the videos will be very long. And two, there are some of you in here that are just basically parroting what I'm saying because you're selling my analysis as your own. So I'm not providing you all of that stuff to make you look even better. And I know some of you might not like that you aren't doing that, but you're like, oh, but you're keeping it from us. I'm not keeping anything from you. These are the things you're supposed to be doing anyway. I promised in the commentaries that I was going to point to where the market's likely to go. I hint at where it likely could draw up into or down into to set up another setup to go where I'm pointing to. So I'm already doing all the leg work for you. It's your job to go in and do the things like I just did here using model number 2. Okay, so hopefully this has been insightful to you. And until I talk to you in model number 3, I can't really say that, can I? I mean, think about it. I'm going to be doing each one of these once a month. So the next one we'll do it the second Saturday of May. Okay, so the second Saturday of May. Let's look at that. What that would be here. May, Saturday, the 14th of May. That will be when I do model number 3's algorithm lecture. Okay, so I literally walked you through the components, what you're doing, what it looks like, why are you doing it this way, what are you looking for, step by step, taking you right into the chart. It absolutely works. It's very precise. It's right out of what I explained, and it was explained years ago. So there's been some delay. Notice that? It ain't like, oh, well, we're going to find something that works. No, I just told you something this Monday. And if this would have been your approach, if you want to be a short-term trader, you don't have to be in front of the charts the whole time, monitoring and babysitting it. You can apply something like this. And it doesn't have to be just this. You can tweak it and fine-tune it with other things that you have grown accustomed to liking and drawn an affinity for with other tools and other approaches and what you're looking for targets and such. And basically make it your own. So this was my submission for model number 2 for algorithmic theory, and actually taking you into the chart. And that's what we'll do when we do model number 3 on May 14th, 2022. Until next time, be safe.